You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good morning, Jim. Good to be with you.
A bit of a turnaround after nothing but losses on the big boards since the start of the year.
Are we going to call it Turnaround Wednesday?
I have no idea.
Well, it did happen on Wednesday.
I don't think it was enough of a turnaround to really give it a pet name.
Well, I guess the big issue has been the ongoing crash in crude oil, going back to spring of 2014 when we were looking for the rally up till around May. And then the price rolling over, and I think the high was 107. And we took that and said it could fall to 1/3 of that price, or to 1/4. And as it turned out, 1/3 was 37, which was reached a few weeks ago, and the 1/4 declined to 1/4 of the high was 27. And Wednesday's intraday low was 27.5. But the interesting thing was that our research was based upon historical, that in a post-bubble environment, commodities are chronically weak in the senior currency terms. And then you had the example of natural gas falling out of a much higher trading range into a much lower trading range. And so that's what we were working on. It had nothing to do with the Saudis or trying to get market share. It was just that, like with farmers in a post-bubble deflation, they are forced to plant from fence post to fence post in order to grow more so they can get more revenues. And what we're doing here in the oil patch is they're drilling from fence post to fence post. And then the other point was technological revolution. In the early 1900s, down in Utah at the huge copper mine down there was the first large porphyry deposit. Bingham Canyon started around 1910, and it showed you could mine low-grade copper ore. Then in the 1970s, with Carlin, Nevada, and then elsewhere with heap leaching, it was shown you could mine low-grade gold ores. And then now with fracking, it shows that you can develop and produce from otherwise rock that you couldn't do before. So there are two things, I guess, then that brought the price down. One was the post-bubble deflation in commodities, and the other was a sensational, terrific, wonderful change in technology. And the result is a low regime for prices. And it also has blown away, I hope forever, the idea of peak oil, that it was going to run out. That's an old Malthusian story from decades ago. So here we are. Now, our work on Wednesday was, last week in Pivotal Events was that the extreme pressures on the down, which, of course, were driving junk bond prices down and widening credit spreads and driving other commodities down and forcing general stock prices down, was that pressure could culminate within a week or so. And then our technical work on Wednesday was that here we've got all kinds of downside exhaustions, capitulations, and the sequential buy patterns coming in on crude. And so there you've got the bounce. And working on it on the stock market side, in this kind of a decline, you can get the bounce can last maybe about eight days. And we call it a reflex bounce. But in looking at the overall stock market in the U.S., we'd never used it before, but in February, started looking at the Dow theory, the very old theory that each of the bull market moves, the Dow had to confirm the move in the industrials, and then when the transports didn't confirm the move in the industrials, then it gave a warning. So, and then we noted that the longer the warning, the divergence, where you were having the transports not make new highs, the more extreme or more lengthy the eventual sell-off would be in most indexes. So that confirmed in May, and so that said that the bull market was over, and that's what we concluded as well. Then the other one was the super action in the Shanghai market, which turned into a bubble, and we looked at the action in Shanghai in 2007 as a guide, and that one, as it was concluding, gave 3 sets of upside exhaustion signals. And in early June came in the 3rd set, but it was only 1 day of 1 reading, but we figured that was enough to say that, hey, the high's in. So here, to finish the stock market side off, the Dow Jones transports continued down, and in December took out the August-September lows and took out the October 2014 lows, which was an important low. So that set the transports into a bear, and then other indexes, important ones like the financials, the bank stocks, XBD, no, that was the broker-dealers, and then the bank stocks, BKX, then did take out the August and September lows, and also the 2014 lows. And in our books, we said that's a bear market, though they were only down about 14%, but you took out those key lows in 2014. So, and then eventually you had the S&P come down very close, a bit below, but not yet a huge failure. And this, of course, was when the downside action was capitulating in crude oil, which was, everything was trading off of that. So we've had the bounce.
Well, Bob, what happens after that?
The probability is that this bounce in the stock market, the nature of it could last for about 8 days. And then what happens after that? Does it go immediately to new lows, or does it set back and find support for a while? That's possible. The other thing is that you're in seasonally now a favorable phase for crude oil and base metal prices, maybe firmness to up into March. But on the other hand, you've got a lot of risk out there. There is huge exposure to everything in Asia, particularly in China. It's still the old problem of they built empty cities and built, industrial warehouses, and everything is just so overbuilt. So you're in exceptional terms, but again, the marketplace comes down to big volatility from extreme fear on the downside to extreme greed or complacency on the upside. And fortunately, with technical analysis, you can measure. One is on the upside, let's use as an example, the momentum. And then there's another one we use, we call it the sequential sell, and that is pattern. So we try to put, when you've got both momentum and pattern coming in saying it's a top, or recently it's a low, it makes a great trading tool.
Now, with crude and the Canadian dollar lockstep together, is there any hope for the loonie or oil prices?
Well, there's no hope for the loonie because you now have a Liberal government. federally in Canada, and what you want to do is look at the Liberal government in Ontario, the province of, where you've had at least 2 election cycles there, and I read somewhere that of all of the sub-sovereign, like you have a country as sovereign, and then within that you have a province or a state. So all of the sub-sovereign borrowers in the world, Ontario is the worst. It's even worse than California, which is an amazing statement. So then this is the culture of the Liberal movement, whether it's provincial or now, regrettably, federal. They see spending as the end-all and be-all of government, and it's not going to be healthy at all. So you could have stability in commodities at some point, and whether the Canadian dollar would stabilize on that, I don't know, because there's going to be no limit to the ambition of this new government. And some of us will be looking back on the Conservative government, which was an attempt to bring back the concept of limited government federally and limit the expansion of government. So it's going to be interesting times, and the Canadian dollar will be the impartial adjudicator on the worth of some of these policies that will come out federally.
Yeah, but don't forget, it was also the Liberals with Paul Martin as finance minister that wiped out the deficit, and it was the Conservatives who ran it up.
Oh, yeah, but sometimes you have market forces. Now, for example, the federal Liberals under Paul Martin had the notion that they should have a balanced budget because that was the political message from the public. So they didn't cut or even slow down the expansion of the federal government. They just passed on a whole lot of budget deficits onto the provinces and said, hey, here we are, no deficit. So anyways, the course in the Canadian dollar is 2 things: weak commodity prices and a very weak, opportunistic, imposing, intrusive government. So I'm not too happy about it.
What about moves that could change things? Can the government really direct an economy, considering that Canada is part of a global slowdown?
Yeah, well, of course, this is one of the great myths in policy making, is they invent this notion of a national economy so they can have a national central bank to manage it. And here we are, the greatest example in the world. If you got a border that's 4,500 miles long of a smaller economy against a huge economy, and these intrusive policymakers in Canada have this egotistical notion that there is a national economy, and what's more, they can manage it, and it's ridiculous. It's just nowhere in the world is there a single isolated national economy. So there's the first strikeout by the concept of interventionists, and the other is that they have this idea that, well, if you look back on all of financial history, you have a business expansion, and with the business expansion, you'll have ambition come to the forefront, and people will borrow money to expand plant and equipment or even just to speculate in. But these naive twits looked at this and said that a credit expansion causes a business expansion, and that's confusing correlation with causation, and the two go together, but it's the same problem is, in the morning when roosters crow, the sun rises. So therefore, crowing causes the sun to rise. And that is what is behind the notion of interventionist economics. So if they see the economy weaker than what they think it should be, which is an arbitrary decision, and so then they push credit out, and they then suppose that it pushes business, but it doesn't, because on the other side, you got the governments bringing in more and more controls and red tape on business and taxation and more or less throttling entrepreneurs, and then they look around and say, oh, the growth isn't good enough, we'll push it with some credit. So, of course, if you've got a choked economy, it's not going to go there, but it'll always go somewhere, and the public will, when it wants to, will choose to speculate in things. They haven't been speculating in commodities lately, but they chose to speculate in, over the last few years, stock markets and lower grade bond markets, plus in the financial capitals, real estate. So there's the other part that the policymakers don't understand. Their world is they push out credit, you get business expansion. The real world is that the public chooses what to speculate in. So I think all of this is going to be very instructive and interesting over the next few years.
Retail spending was up 1.7% in November in Canada. Some of the central bankers are saying, see, we told you that lower oil prices would lead to new consumer spending. It's like a tax break. However, do they ever think about there's a little seasonality there, that there's going to be a jolly guy with a beard wearing red and white coming down a chimney?
Oh, yeah. Of course, maybe retail sales are up because groceries are costing so much now. I mean, you get fresh vegetables from the States. You know, we got an automatic 25% increase just on the currency conversion. So, no, economics is a poor, diluted world. They should be, you know, you can't go and fire all the economists, but you should just sort of put them in a room, let them play with their computers, but for gosh sake, don't have any of the wires connected to anything real out there. Just leave them, keep them busy, pay them lots of money, and keep them all happy, but don't hook it up to reality.
Well, we're still told inflation is below the Bank of Canada's rate of 2%. However, their inflation rate excludes fuel prices, food prices, and housing. So as long as you don't live anywhere, eat anything, and don't move, you're okay.
Well, then also the rates of calculation vary all over the place. In the U.S., you got about 3 different calculations on the CPI. If you use the pre-1981, you're something around 9 or 10% annually. Then there's another one you calculate, and it's at 5%, say. And then there's one that they watch for some reason or other. It's sort of saying it's around 2%. So again, that just shows that the inaccuracy of the concept of an economy, an economist, and the ability to influence the financial markets. It really has been one of the great delusions in history.
Well, like Churchill said, there are lies, damn lies, and statistics.
Yes.
Bob, thanks a lot for chatting with us.
Good to be with you, and look forward to next week.
My guest has been Bob Hoye. He's the Chief Investment Strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our popular YouTube channel is Talk Digital Network. You can forward questions or comments to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.